Hey everybody, this is Mike Fox. I just wanted to kind of give you a little overview of chapters 3, 4, and 5 this week. Uh, 3 and 4 you're not really getting into the nitty-gritty of any financial data yet. They're just giving you more reasons why you should be interested in financial intelligence or improving your financial intelligence. I think it's pretty obvious to most of us, those of us who are in business at all, that having an understanding of our financial numbers is important because it helps us make better decisions. Really what managers do is they plan and then they control, meaning making sure we adhere to the plan, and then they review the plans and make new plans. That's what management is. And whether you're a business owner or a business manager, what we have to do is make plans for the future, and then we have to ensure that people adhere to the plans we've made, and then we have to review them and make changes and improvements to them. I mean, there's other things we do, of course, but generally speaking, that's what managers do. And so if you don't understand the finances of a business, it's pretty hard to make plans for the business. And it's pretty hard to ensure people are sticking to those plans, and it's pretty hard to review those plans. So that's the reason that we need to understand financial intelligence. It's certainly the reason any employer that wants you to work as a manager wants you to have that basic knowledge. So that's really what they cover in Chapter 3. Chapter 4 talks a little bit about accounting and sort of the basic rules that accountants follow, and why managers don't always need to follow those rules. Certainly when we're doing reporting for the IRS, or we're doing reporting for public entities, say we have a publicly traded company and we're reporting to the stock markets, of course we have to follow all of those rules. It's important that we use a standardized methodology. But when we're using financial information for business decisions, we don't always have to worry about all of the accounting rules. Instead, what we need to do is use the numbers and use the data to make intelligent business decisions. And so that's what this course focuses on. This is not a financial accounting course where we're worried about following all of the standard rules that apply for the IRS and for other reporting entities. Instead, we're worried about making intelligent decisions and understanding how the actions of the managers and the actions of the employees, how those impact the financial situation of the business. So that's 3 and 4, and then Chapter 5 introduces you to the financial statements, and we get into what's called an income statement. Sometimes it's referred to as a profit and loss or a P&L statement. The terms P&L and income statement are synonymous terms. I thought probably the best way to kind of introduce you to the income statement would just be to give you a brief walkthrough of all of the line items that you'll find on an income statement. So I went to Yahoo Finance and I looked up a company that I'm sure some of you are familiar with. This is the Kroger Company. Kroger Company is a large retailer. They own a number of subsidiary grocery companies in Arizona. They own Fry's, for one, and they own others. Back east, they're just called Kroger. If you go to Michigan, then the stores are called Kroger. And there's a whole bunch of other things that they're involved in as well, but that's probably the name that you would know them as, is Fry's out in the west here, or Kroger back east, and some other names that others I'm probably not even familiar with, other regional names. Anyway, so if you go to Yahoo Finance, you can look up any company's financial statements by scrolling down and on the left, clicking on them. So this is the income statement. Just let me show you a few features first of all. Up here, there's a little legend that tells us that all numbers are in thousands. What that means is that we have to add 3 zeros to any number on this page to get the actual number. And they just take 3 zeros off to make it fit in a smaller space. So this revenue number, total revenue, is 108,465,000,000, because we would have to add 3 zeros there. So the way an income statement works, first of all, is that it covers a period of time. So you'll notice over here it says period ending, and then it says January 31st, 2015. So this column is going to represent all of the revenue and the expenses that the Kroger company incurred, or the revenue that they earned in the period that went from February 2nd, 2014 through January 31st, 2015. That's what this column will represent. When we get into things like balance sheets, we'll find out that those don't represent a period or a window of time. Instead, they represent a moment in time. But for now, it's enough to think about the income statement and say, so each of these columns represents a year. So let's talk about what each line item means. The first line item in the income statement is total revenue. Some income statements will say sales or sales revenue or gross revenue. All of those terms pretty much mean the same thing. What they mean is money that the business has brought in through operations. So in the case of Kroger, this is money they brought in by selling stuff to people because they're a retailer. They sell goods to customers, usually individual customers. So that's what revenue represents. So in the year ending January 31st, 2015, Kroger sold $108,465 million worth of stuff to its customers. That's the revenue. The second line item is the cost of revenue. This is the cost of the stuff, or the goods, that Kroger is selling to the customers. So when they buy merchandise or inventory from the suppliers, the cost that they pay goes on this line item. So that's the cost of revenue. And then the third line item is the gross profit. The gross profit is the total revenue minus the cost of earning that revenue. And so the gross profit of Kroger for this period is $22,953 million. So this is the profit before operating expenses. The next section will give us the operating expenses. You'll see on this income statement, they're all lumped together into a single or a couple line items. Some income statements have a lot more detail, okay, where they break down each operating expense. So this says that they didn't spend anything on research and development, or at least they didn't report anything being spent there, but they did spend $17,868 million on selling general and administrative expenses. So this will include things like the salary of store employees, the salary of the CEO, the salary of all of the accountants, any rents they're paying on leased space, any utilities they're paying, any insurance. All of those expenses are lumped into the selling, general, and administrative expenses. So that's a lot of money, $17.8 billion spent there. And then they didn't list anything as a non-recurring expense. As you can guess, that means expenses that don't happen over and over each period, but that are occasional, but they had none. And they did have $1,948 million in other expenses. And there's no detail really that we can find as far as what that means. Sometimes if you read the company's their annual report, they'll give additional detail on what some of those other expenses might be. So when we subtract the operating expenses from our gross profit, that leaves us with what's called the operating income. Then sometimes they'll subtract out something called other income or expenses. You'll see in this case there weren't any. And so once they do that, we're left with something called earnings before interest and taxes. A lot of times the term earning before interest and taxes, or EBIT or EBIT, that becomes synonymous with operating income. And so you'll see in this case the numbers are the same. So if that's our earnings before our interest and taxes, then the next line item, as you can guess, is going to be our interest expense. They paid $488 million in interest expense last year. When you subtract that out, you're left with the income before tax. And then we subtract out the tax expense of $902 million. And they subtract out something called minority interest. What that has to do, it's a complicated thing that's kind of beyond the scope of what we want to go into here. But in essence, a minority interest means that there's other companies that own parts of the Kroger company. Maybe some of their subsidiaries are partially owned by other companies. And so a portion of that income tax expense is being paid by those other companies. And so $19 million of it is actually coming back here. It's reducing the amount of income tax expense we subtract out here. So that's what that means. If you want to read about it, you can Google it and read all about that, but it's a little more technical. Anyway, so when we subtract the income tax expense, we add that minority interest back in, we're left with a net income from continuing operations of $1,728 million. You'll see some other line items down here for non-recurring events. As you can imagine, those are simply events that are non-recurring, things that are happening that happen in a business on a given year but don't normally happen. They like to separate those out so that people reading the income statement can recognize that even though that did reduce their profit, it's not a normal thing. It's a special or an extraordinary item that happened just for this period. But during this period, you can see that Kroger did not have any of those non-recurring events, so their net income is the same as their net income from continuing operations of $1,728 million. And remember, it looks like 1,728,000, but because all of our numbers are in thousands, we're adding 3 zeros onto that, and it's 1.7 billion. Looking at this, it's a pretty strong income statement. The Kroger company has grown their sales from 19.8 billion to 20.2 billion to 22.9 billion. So they've had growth every year. I'm sorry, not sales. That was their gross profit. Their sales have grown from 96 billion to 98 to 108. And their net income, their profit has grown from 1.49 to 1.51 to 1.78 or 73 billion. So they're growing each year. Their profit's growing each year. Those are encouraging signs. Later in the course, when we go over balance sheets, I'll use the same company and we can kind of compare and see how it looks like they're doing there. So that's kind of a tour of an income statement. The last thing I'd like to express, and you'll read about it in the textbook as you do the reading this week, is that even though these numbers seem like they're really hard numbers, really specific numbers, many of them are estimates. You learned in the first couple chapters that things that we think are hard and fast numbers are based at least partially on estimates. There were decisions made about how revenue would be recorded and whether revenue earned from certain activities would be reported in this period or the next period or the last period that affect that revenue number. So somebody had to make a judgment call to decide how they were going to recognize all that revenue, to decide what expenses they would recognize and how they would do that, and various other issues that could adjust or make these numbers really just an approximation or an estimation of the profit of the business. And so that's just something I wanted to make real clear, is that income statements aren't perfect, even though it seems like they would be because it's hard numbers sitting right in front of you. They are still an estimate, and in chapters 1 and 2, they covered that pretty well. Anyway, that's really all I have for these chapters 3, 4, and 5. The assignment should be pretty doable. Of course, if you need help with it, you can contact me. You can text me or email me, or you can call me, and all of my contact information is back in Web Study at the top of the timeline where you can click on the course syllabus, and I also emailed that syllabus to you with the same contact information. So if you need anything, let me know. I will do my best to help you, and good luck this week.